Bitcoin is trading at exactly the same price it first peaked at in November 2021. And on the same day that happened, the SEC and CFTC just ended their decade-long war over who controls crypto. Let that land for a moment. The asset that regulators spent 10 years fighting over has now become the thing two of the most powerful financial regulators in the world are rushing to claim jurisdiction over. Meanwhile, you are watching Bitcoin sit at $69,500 and wondering whether the cycle is over. The data says the question you should be asking is entirely different. And by the time this ends, you will understand exactly why. There is a number that has not been discussed on this channel yet. It was crossed sometime in the last 60 days, and the last time it happened, it marked one of the most significant inflection points in Bitcoin's entire history. The reading right now is extraordinary. I will give you the full context in a few minutes. Stay with it. Here is what the rest of crypto YouTube is saying right now. They are covering the Iran war. They are covering the price drop. They are comparing this to 2022. Some are calling it a bear market. A few are calling it a buying opportunity. Almost none of them are covering what is actually happening in the regulatory architecture of this market. And none of them are pointing to the on-chain signal that institutions are reading right now while retail argues about charts on social media. Let us get oriented. Bitcoin is currently trading at $69,500. For context, that price has a very specific resonance. In November 2021, 4 years ago, Bitcoin hit $69,000 for the first time ever, and the entire world lost its mind. That was the all-time high, the culmination of an entire cycle, the peak that preceded an 18-month 77% crash. Today, Bitcoin is at that same price, not as a peak, not as a milestone, but as a pit stop in a correction that started at $120,198 in October 2025. The same price that was once an all-time high is now a support level during a pullback. Let that tell you something about where this asset is in its long arc. The prevailing narrative in crypto media this week is simple. Iran war equals macro risk equals Bitcoin selling. That narrative is not wrong, but it is incomplete. The part the headlines are skipping is that since the Iran conflict began, Bitcoin is up 8%, gold is down 1% from its spike high, the S&P 500 is flat. Bitcoin, the asset that everyone calls risky, has outperformed every traditional safe haven during an active geopolitical crisis. That is not an accident. That is a structural shift in how global capital treats this asset under stress. The cycle position right now is month 23, post the April 2024 halving. Bitcoin peaked at $126,998 in October 2025, which was month 18 post-halving, exactly in line with the previous two cycles. We are now 5 months into the post-peak correction. That is a specific place on a specific map. And the metric that tells you exactly where you stand on that map, the one I am going to give you the full reading on in a few minutes, has never been covered on this channel. The historical context for where it sits right now is the kind of data point that changes how you think about your next 6 months. The market structure since October 2025 has been a textbook downtrend. That is not analysis, and it is description. Lower highs, lower lows. The last significant high was approximately $98,000. That is not just a round number. That is the structural break level. Bitcoin needs to close above $98,000 on the daily with conviction and follow-through buying to technically exit the macro downtrend it has been in since last October. Until that happens, every rally is a rally inside a downtrend, and every support test is a test with context. Where's price right now within that structure? Bitcoin is sitting between its first and second layers of support. The $67,000 to $68,000 zone represents the realized cost basis of short-term holders, the last group of buyers who entered in the 3 to 6 month window before today. When Bitcoin sits at their break-even, two things happen. Sellers who were underwater stop hitting the sell button because they are no longer losing. And buyers watch carefully because at close below that level means short-term holders collectively go underwater, which historically precedes further forced selling. That support band is the first line. The second support is $63,000, the intraday low hit during the peak Iran war fear earlier this month. That level was tested, held, and produced a sharp reversal. It now represents a proven demand zone, not just a number on a chart. Markets remember levels that held under maximum pressure. The third and most important support is $60,000. That was the February 2026 cycle low. The floor hit when the fear and greed index dropped to 8. That is the line that must not close below on the weekly. If it does, the cycle narrative changes materially. On the resistance side, $73,000 to $75,000 is where the 50-day moving average currently resides. Every rally into that zone has faced selling from participants who bought higher and are watching for break-even. The next meaningful resistance above that is $80,000, a level with significant psychological and structural weight. And then the critical level, $98,000. That is the downtrend break. That is the level where the technical picture flips. The daily RSI is recovering from its most oversold reading since mid-2024. Volume behavior has been constructive. Selling volume has decreased on each successive test of support, which means sellers are getting exhausted. Open interest in Bitcoin futures has risen more than 5% alongside the current recovery, which indicates fresh capital entering long positions. Not short covering alone. That is a meaningful distinction. The next major liquidation cluster above the market sits at approximately $75,000. A move through that level would force a cascade of short position closures, which mechanically adds buying pressure. That is not prediction. It is the structure of the derivatives market right now. The data you just heard is not on most channels. You found one that does this. Stay with it. Now, let us talk about what institutions are actually doing, because the gap between what the financial media reports and what the on-chain data shows is exactly the kind of signal this channel was built to surface. The public narrative this week is fear, Iran, macro headwinds, Bitcoin in a downtrend, rate cuts delayed, geopolitical risk. That is the surface. Underneath it, the data shows something completely different. Strategy, the largest corporate Bitcoin holder in the world, has now purchased Bitcoin for 12 consecutive weeks in 2026. 12 straight weeks. During every single dip, every fear spike, every Iran headline they were buying. Last week alone, they added 17,994 BTC for $1.28 billion at an average price of $70,946 per coin. Their total stack now stands at 738,731 Bitcoin acquired for $56.04 billion at an average cost of $75,162 per coin. At today's price of $1,695, they're sitting on approximately $4.7 billion in unrealized loss. And they just bought $1.3 billion more. That is not panic selling. That is conviction at scale that retail investors typically do not have access to model. Now look at the ETF data. After 5 consecutive weeks of net outflows during the February correction, 5 weeks during which Bitcoin fell from above $95,000 to $60,000, the flows reversed. In early March, $568 million in net inflows entered spot Bitcoin ETFs. On March 4th alone, $461 million entered in a single session. 10 of the 11 existing Bitcoin ETFs recorded positive flows simultaneously on that day. The last time that kind of synchronized inflow occurred was January 2024, the week the ETFs launched. BlackRock's IBIT captured 66% of all those flows. Since February 24th, BlackRock has accumulated a net 21,814 BTC valued at approximately $1.55 billion at current prices. Their total AUM now stands near $50 billion. And then there is the development that most channels have not fully processed yet. Morgan Stanley has filed with the SEC for its own spot Bitcoin ETF, naming Coinbase and BNY Mellon as custodian partners. Here is why that matters beyond the headline. When the first wave of ETFs launched in January 2024, a substantial portion of early inflows were grayscale rotation, capital moving between products rather than entering the market fresh. That rotation-driven flow no longer exists as a structural headwind. A Morgan Stanley Bitcoin ETF represents net new institutional demand from clients who currently have no direct Bitcoin exposure through that platform. Every dollar that flows into that product is new buying pressure against a fixed supply. The filing happened while Bitcoin was in a downtrend and while Iran war headlines dominated financial news. That timing is not accidental. Here is the historical parallel that deserves your full attention. In August 2017, major institutional players were completely absent from Bitcoin. The asset was viewed as a speculative instrument with no regulatory clarity and no institutional infrastructure. By December 2017, Bitcoin had traded above $19,000 for the first time. The absence of institutional infrastructure in 2017 was actually a feature of that cycle, retail-driven, unstructured, and ultimately fragile. The crash that followed in 2018 was brutal precisely because there was no floor. In March 2026, there is a floor. It is institutional, it is structured, and it just got significantly wider. The macro picture this week requires 2 things to hold simultaneously in your mind: a challenging environment and a shifting one. The Federal Reserve held rates at 3.5 to 3.75% and will hold them again at the March 17-18 FOMC meeting. The probability of a cut next week is 99% in the no change direction. Rate cut expectations for April have collapsed from 21% 1 month ago to just 11% today. The reason is straightforward. February CPI came in at 2.4% year over year, exactly as forecast. Core CPI at 2.5%. Inflation is not accelerating, but it is not at the 2% target either, and the Iran war's impact on oil prices, WTI is at $87 per barrel, creates uncertainty about where inflation heads from here. The dollar, measured by DXY, peaked at 99.7 during peak Iran war fear and has since pulled back to 98.5 after Trump said the conflict could end very soon. Every 1% decline in DXY has historically provided a tailwind for Bitcoin, which carries a strong inverse correlation to dollar strength. If the Iran situation de-escalates further in the next 2 weeks, the DXY retreat could become a meaningful catalyst for risk assets. The US 10-year Treasury yield sits at 4.18%. That number is the risk-free rate that every asset on Earth is priced against. As long as it remains above 4%, there is structural pressure on assets that do not pay a yield. Bitcoin pays no yield. That is a genuine macro headwind. The tailwind, if the Fed signals dovishness at the March 18th statement, even without a cut, is that forward rate expectations would reprice rapidly and risk assets historically front-run rate cuts by several months. The regulatory picture, however, changed materially today. The SEC and CFTC, two agencies that spent a decade fighting over jurisdiction of the same assets, signed a memorandum of understanding to coordinate crypto oversight. The document covers 6 priority areas: a shared crypto asset taxonomy, coordinated enforcement, and a joint firm consultation platform. They are launching Project Crypto as a unified initiative. Whatever you think about regulators, this matters for one specific reason. The single largest structural risk premium embedded in Bitcoin's price for the past decade has been regulatory ambiguity in the United States. Today, that risk premium shrank measurably. The Clarity Act in the Senate remains stalled over stablecoin yield disputes, but Senators Alsobrooks and Tillis are working a compromise. The SEC and CFTC MOU may actually accelerate that process by removing interagency friction from the legislative debate. So the next step is a Senate Banking Committee markup hearing. When that hearing is scheduled, it will be a catalyst event. Macro looks challenging. But the regulatory infrastructure beneath Bitcoin just got meaningfully stronger. Now here is where it gets interesting. The metric I mentioned at the start of this video, the one with the extraordinary historical reading, is Bitcoin exchange reserves. Here is the full picture. Exchange reserves measure how much Bitcoin is sitting on centralized exchanges available to be sold. When that number is high, there is abundant supply. Sellers have easy access to liquidity, and downward price pressure is structurally embedded in the market. When that number falls, it means Bitcoin is moving off exchanges into cold storage, into institutional custody, into ETF vaults. Supply that leaves exchanges is supply that cannot immediately be sold. It is supply that has to be actively retrieved before it can become selling pressure. That distinction matters enormously. Current exchange reserves sit at approximately 2.7 million BTC. That is the lowest level since November 2018. Let me give you the context for November 2018. That was the month Bitcoin was actively crashing. The price was in free fall, where it would bottom at $3,200 in December 2018. The fear and greed index was deep in extreme fear. Retail was selling everything. And yet, exchange reserves were also falling because a different class of buyer was quietly moving Bitcoin off exchanges and into long-term storage. They were not participating in the panic. They were engineering the foundation of the next cycle. From December 2018 to December 2020, Bitcoin went from $3,200 to $29,000. From $29,000 to $69,000 in November 2021. From $69,000, that exact price Bitcoin is trading at today, to $126,198 in October 2025. The exchange reserve signal does not tell you the exact bottom. It tells you that the structural setup that historically precedes multi-year Bitcoin advances is present right now. Available sell-side supply on exchanges is at a level not seen since the asset was in the process of finding its last major generational bottom. Now combine that with the whale accumulation data. During the period when the fear and greed index hit 8, its lowest reading in years, whale wallets accumulated 270,000 BTC. That is $23 billion in Bitcoin purchased during maximum retail panic. It is the largest net whale accumulation event recorded in over 13 years. Those coins did not come from institutions panic selling. They came from retail wallets that were unable to hold through the fear. The MVRV Z-score currently sits in a zone that historically appears during either late-stage corrections or early-stage recovery, not during overextended bull markets. Only 57% of the Bitcoin supply is currently in profit, which means 43% of all Bitcoin in existence is held by someone paying more than today's price for it. Historically, that specific threshold has appeared at market turning points, not always bottoms, but never during the manic stages of a bull market. Miners are sending a secondary signal worth noting. Bitcoin difficulty jumped 15% in February, the largest single increase since 2021, while hash price simultaneously hit all-time lows at $30, or just 18 per petahash per day. That combination means miners are competing harder for the same revenue, and the marginal miner is under severe pressure. The next difficulty adjustment on March 20th is expected to decrease by approximately 6%, which would be the first downward adjustment in several months. Historically, miner capitulation, miners selling their reserves to cover operating costs, precedes price bottoms. The network's security is stronger than it has ever been. The miners funding that security are under maximum stress. That divergence is a signal. The fear and greed index currently sits in the low to mid-20s. It was 8 less than a month ago. The trajectory is upward, but it remains deep in extreme fear territory. Every single time in Bitcoin's history that the index recovered from a sub-10 reading, it was followed by a sustained upward move in price. Not immediately, but systematically. This is the intelligence layer that separates decisions from reactions. We build this every single week here. The moment in Bitcoin history that most closely rhymes with right now is not 2022. Everyone is pointing to 2022. That comparison is structurally incomplete. In November 2021, Bitcoin hit its cycle peak at $69,000. It then entered a 17-month bear market, eventually bottoming at $15,500 in November 2022. During that entire period, the following things were true. There were no spot Bitcoin ETFs. There were no Bitcoin native institutional custody solutions at scale. The regulatory environment was actively hostile. Major crypto entities, exchanges, lenders, funds were imploding. The fear and greed index was driven by genuine structural collapse, not price correction. None of those conditions exist today. There are no structural collapses. There are no fraud-driven liquidations. The entities imploding in this correction are retail leveraged traders, not institutional infrastructure. The more precise historical parallel is the period from May to July 2021. In May 2021, Bitcoin peaked at approximately $65,000. It then corrected sharply to $29,000 by late June, a 55% drawdown in 47 days. The fear and greed index fell to 10. Exchange reserves dropped sharply. Whale accumulation accelerated. Every narrative said the bull market was over. Bloomberg Intelligence ran coverage suggesting the cycle had peaked. Social media was a wall of capitulation posts. By November 2021, Bitcoin had recovered from $29,000 to $69,000. The same month, the same price, a 138% advance from a point that felt like the end. Bitcoin today has fallen 45% from $198. The cycle structure, the on-chain signals, and the accumulation behavior all rhyme with that May to July 2021 period more closely than with 2022. I'm not saying history repeats, I'm saying the data rhymes. And right now, it is humming a very familiar tune. The next 30 days contain 3 specific calendar catalysts that will define Bitcoin's trajectory more than any single macro variable. The first is March 17th to 18. That is the FOMC meeting. The Fed will not cut rates. That is already priced. What matters is the language. If the statement signals greater concern about growth relative to inflation, forward rate expectations will shift. The dollar will weaken further and risk assets will front-run the first actual cut. If the statement leans hawkish, emphasizing that the Iran oil shock makes inflation management harder, the DXY could strengthen and Bitcoin's near-term path narrows. The signal to watch is not the rate decision. It is the balance of risk language in the statement. The second catalyst is March 20th. That is the Bitcoin network difficulty adjustment, expected to decrease by approximately 6%. When difficulty decreases, the weakest miners exit the network. The remaining miners become more profitable, and the structural selling pressure from miner liquidations reduces. Minor capitulation events have historically been within weeks of cycle lows. The March 20th adjustment, if it marks the beginning of a downward difficulty trend, is a secondary signal that the network is processing its own pain. The third catalyst has no exact date but is approaching. The Senate Banking Committee markup hearing for the Clarity Act. When that date is announced, it will represent the first formal step toward a legal framework for digital assets in the United States. Given today's SEC and CFTC MOU, which removes the jurisdictional obstacle that was genuinely blocking legislative progress, that markup hearing may now be closer than the market has priced. Now the forward structure. There are 3 price levels that define the next move. If Bitcoin closes above $75,000 on the daily with expanding volume, the short squeeze at that level triggers a mechanical move toward $80,000. That becomes the test. A confirmed close above $80,000 shifts the narrative from recovery rally inside a downtrend to early structural reversal attempt. If Bitcoin loses $67,000 on the daily, meaning a confirmed close below short-term holder cost basis, selling pressure from capitulating holders accelerates toward $63,000 and then toward the $60,000 floor. If $60,000 breaks on a weekly close, the cycle positioning narrative becomes materially more bearish, and the 2022 style comparison becomes structurally valid for the first time. The single signal that confirms which of these paths wins first: dollar direction. If DXY falls below 97, which requires either Iran de-escalation, a Fed dovish shift, or both, Bitcoin has the macro tailwind to attack $75,000 and above. If DXY reclaims above 100, the inverse correlation becomes a ceiling, not a floor. If DXY closes below 97 and Bitcoin holds $67,000, then the path to $80,000 opens with high probability. If DXY holds above 99.5 and Bitcoin loses $67,000, then $63,000 is the next meaningful stop. If the FOMC March 18th statement surprises dovish and exchange reserves continue declining, then the short squeeze at $75,000 becomes the most important event of the next 60 days. This is a strategic briefing, not a prediction. The conditions are identified. The catalysts are calendared. The signals are named. The rest is positioning. The most important thing to understand about this moment in Bitcoin's history is not the price. It is the architecture underneath the price. When Bitcoin was at $69,000 in November 2021, the following was true. No institutional custody infrastructure, no spot ETFs, an SEC actively hostile to digital assets, no clear regulatory framework anywhere in the Western world, and no coordinated oversight between the agencies that govern U.S. capital markets. Every institutional dollar that wanted Bitcoin exposure had no clean on-ramp. Today, Bitcoin is at the same number, $60,500, and the following is true. $53 billion in cumulative ETF inflows since January 2024, BlackRock managing $50 billion in Bitcoin assets. Morgan Stanley filing for its own ETF, 738,000 Bitcoin held in a single corporate treasury, the SEC and CFTC signing a landmark cooperation agreement, and exchange reserves at the lowest level since 2018 because smart capital is moving supply off the market. The same price, a completely different world underneath it. While most people are comparing this chart to 2022 and preparing for a crash, the data shows that institutional accumulation at these levels is occurring at a pace not seen in 13 years. The people watching the right data right now are not watching price. They're watching the signals beneath price. They are tracking what entities with genuine resources are doing with those resources during periods when the price makes retail participants feel sick. And what those entities are doing with absolute consistency is buying. That is the behavioral difference. Not conviction that price cannot fall further, not certainty about the next 6 months. The difference is knowing what the institutional accumulation signal looks like, knowing where supply is going, knowing what regulatory events change the long-term risk premium, and building a framework around data rather than emotion. The people who saw the 2019 recovery coming were not watching headlines. They were watching exchange reserves. They were watching whale accumulation. They were watching the architecture that forms beneath price during maximum fear. The people who see what comes next will be watching the same signals, just 12 years later, at 10 times the institutional scale. The architecture has never been stronger. The fear has rarely been more extreme. That is not a coincidence. That is the pattern. There is one final number worth leaving you with. As of today, March 11th, 2026, the SEC and CFTC have formalized a Memorandum of Understanding covering joint crypto oversight. In their official press release, they referenced shared taxonomy development, coordinated enforcement, and the elimination of the regulatory ambiguity that has been embedded in Bitcoin's risk premium since its inception. The last time an event of this regulatory magnitude affected Bitcoin's structural environment was in January 2024, when the spot ETF approval opened institutional access to the asset for the first time. Bitcoin went from approximately $46,000 at ETF approval to $126 on 190 stars 14 months later. Today's event does not repeat that catalyst, but it is the same class of event. Structural, irreversible, the kind of shift that the data will confirm in hindsight, but that feels quiet in real time. What I will be watching next week is the FOMC statement language on March 18th, specifically whether the Fed uses the phrase balanced risks in its inflation versus growth assessment. That phrase, in Fed communications, has historically preceded policy pivots by 2 to 3 meetings. It has appeared before every major rate cut cycle in the past 20 years. If you hear it on Wednesday, pay attention.